Mm. Hello everyone. Today I will briefly explain two important concepts from SLFRS 9 with examples. The first one is amortized cost with effective interest rate. So amortized cost means it is the amount at which a financial asset or liability is initially recognized. So the effective interest rate means the EIR is the discount rate that exactly equates the present value of expected cash flows of the instrument to its initially carrying amount. So let's look at the example. The question one, a company lends 500,000 to a customer for 3 years at an interest rate of 8% per year. The customer agrees to pay in equal annual installments. The first question is calculate the annual installment amount. So let's look how to solve this question. So to find the annual installment amount, we have to use this annuity equation. So A equal P into R divided by 1 minus within bracket 1 plus R to the power minus N. So in here, the P is denoted by the principal amount and the R is denoted by annual interest rate and the N is number of years. So according to the question, the principal amount is 500,000. So we have to substitute 500,000 for P. And for R, the annual interest rate is 8%. So if we simplify this 8%, it will gives that 0.08. So in the denominators, so 1 minus 1 plus again R. So R means the annual interest rate, same as the numerator 0.08. Close the bracket and the end is number of years. So here the agreement is for 3 years. So the end is denoted by minus 3. So if we simplify this equation, we will get the answer as 194,016 rupees point 76 cents. So this amount is the annual installment. So the second question is prepare an amortization schedule showing beginning balance, interest, payment, and ending balance for each year using the effective interest rate method. So this is the format of the amortization schedule. So as we ask from the question, so we have to include the year, beginning balance, the interest, and the annual payment, principal amount, and the ending balance. So we all know that the annual payment is consist of two sections, so two parts. The first part, the one part is the principal amount. So the annual payment always includes the principal amount and plus interest. So the previous question we have calculated that the installment is consist the principal amount and interest amount. So okay, let's see. For the year one, the beginning balance is 500,000. That's the initial amount that the company lends. So for that 500,000, we have to look the interest. So the interest is 8%. So we have to look 8% from that 500,000. So that is 40,000. So 40,000 is the interest that the customer need to pay for the year one. So we have already calculated the annual installment. So as I said, the annual installment is consist of principal and the interest. So we have calculated the interest. So the interest is 40,000. From this annual installment, we have to subtract this interest in order to get the principal amount. So here the principal amount is 154,016 rupees and 0.76 cents. So this is the amount that going to be deducted from the your loan amount, because the interest is an additional expense. So the principal amount, we have to deduct that principal amount from the beginning balance. So for the 500,000 we have to deduct this 154,016 rupees 0.76 cents. So the ending balance is 345,983.24 cents. So this is the ending balance of the first year, and this balance we have to board that balance into the opening balance of the second year. From the second year, the beginning balance will be the 345,983.24 cents. For now, we have to look the interest for this 345,983.24, not for the 500,000. So if you look 8% from the for this beginning balance, the interest for the second year would be 27,678.66 cents. So this will be the interest rate, interest for the second year. So again, the annual, they have already said that the annual amount is equally and the same amount, so we have pay the equal amount. So for the second years also, the annual payment will be 194,016.76 rupees. So in order to find the principal, we have to deduct this annual amount from this interest. So the principal amount for the second year will be 166,338.10. So in order to find the ending balance, we have to deduct this 345,983.24 rupees and 166,338.10. So we will get the ending balance as 179,645.15. So we have to board these balance to the third year as a third year opening balance. Again, the same procedure. So we have to look 8% interest for this 179,645.15 rupees. So the interest is 14,371.61. So in order to find the principal amount, we have to deduct 194,016.76 cents rupees. We have to deduct that interest 14,371.61 rupees. So the principal amount will be 179,645.15. The beginning balance of the fourth year, the third year also 179,645.15. So the ending balance will be 0. So you have to be very careful uh, when you round off these figures. If sometimes if you have uh, round off to the 3 digits, so sometimes the balances would be differ. So at last, final, we have to find the total interest for 3 years. So we have to add the interest column 40,000, 27,678.66, 14,371.61. So the total is 82,050.27 rupees. So so this shows us how the amortized cost decreases every year while the effective interest rate ensures equal annual payment. So let's move to the second concept, that is expected credit loss. So the expected credit loss or the ECL model under SLFRS 9 is must estimate. So it says that banks must estimate possible future credit losses instead of waiting until they actually happen. So let's look the example. The first one, the example says a bank has given a loan of rupees 1 million based on following risks. So the first one is probability of default 5%. Second one is loss given default 40%. And third one is exposure at default 1 million assessment. So the ECL model is consist of these three items that are probability of default, loss given default, and exposure at default. In order to find the ECL, the expected credit loss, we have to multiply these three things. So let's go for the answer. So this is a 12-month ECL model. So the first question is we have to ask that to calculate the expected credit loss. So in here we have given with all the requirements. Probability of default is 5%, loss given default is 40%, and exposure at default is 1 million. So simply we have to multiply all these all these three things. So the expected credit loss will be 20,000. We have to multiply the probability of default, that's 5%, loss given default, that is 40%, and exposure at default, that is 1 million. So the answer is 20,000. So the second one, it says that if the PD increases to 12% in stage 2, so the first question, the first in the scenario they given that the probability of default is 5%. Now they say that if the PD, the probability of default is increases to 12%, what will happen? Okay, so again to the same equation, but this time the PD is not 5%, it's increased up to 12%. So the PD is 12%. Loss given default is same 40%, and the EAD also same 1 million. But this time the answer is 48,000. So it says that if the risks are higher, with the risks, if the risks are higher, the loss also will be higher. So this shows how banks adjust their accounts to reflect the real credit risks, giving us more transparent and reliable financial reporting. So as a summary, the amortized cost and EIR explains how repayment splits between interest and principal, and the ECL model explains how we estimate credit losses at different stages. Thank you.